First of all, I would like to give you an overview of free cash flows. We spoke about that several times, but let me remind you once again. So free cash flows equal to what? EBIT, earnings before interest and tax, from the P&L times 1 less profit tax, okay, plus you add back amortization. It's a non-cash item. You have to remove amortization from the EBIT, minus investment in CapEx, capital expenditure, or your annual investments in tangible, intangible assets, whatever, minus investment in net working capital. Net working capital, short-term assets less short-term liabilities. So by doing that, you remove from the EBIT receivables, you remove payables, which are non-cash items, you add cash items such as stocks, inventories. So to have the cash flow, operating cash flow up to 1 year, you see that you remove amortization, depreciation from the EBIT as well, and you have to consider profit tax applied on EBIT. Of course, your investments are cash outflows as well here. So basically, free cash flow represents the cash a company generates from operating activities and investment activities. Here, operating, it's EBIT, it's net working capital up to 1 year. Investment activities are the CapExes here. So there are no finance activities here, such as debt repayment, financial interest, or dividends. This is why we call free, without money providers. In simple words, there is no cash considered which goes to the money providers. Free cash flow is giving a much better position than dividends or net profits, earnings per share, because it takes into account all the cash flows from the company, all the cash flows. Before we dive in, let me explain why we need to use free cash flows to value a company. Well, if you see some of the stock prices on the stock exchange of companies like Apple, Microsoft, or Tesla, how do you know, my dear students, if their stock price on market capitalizations are overvalued or undervalued? You don't know. Actually, what do you have to do? You have to then to apply what I have tried to teach you, the free cash flow model, which will help you to use the intrinsic values of the company, such as operating and investment cash flows going forever, discounted to today, to see if the obtained company value is more or less the value you see on the market, which is under many constant influences. So the market prices does not always reflect the present value of the cash flows. So this is why the best way to see whether your stocks are overvalued or undervalued on stock exchange, it is to apply the methods such as free cash flow. When we are buying a company, we always value it using free cash flows, which is, I remind, discounted with the WACC. Now you see the purpose of the WACC. WACC is very important because you have to calculate your value of the company, I mean the free cash flows, by discounting them with the WACC. WACC is the discount rate used to discount the free cash flows going forever.